what's up, guys? It's Amanda here. So something that I get asked all the time, and I mean all the time, is how do you buy your first rental property? What do you look for? How much money do you actually need? And how do you know if it's a good investment? And real quick, before we get into it, if you haven't already hit the like button, please do that now. It helps this channel grow and it helps me keep making real estate and investment content that's actually going to help you build wealth. And if you're new here, make sure you subscribe because we talk about real estate investing, building wealth, and how I became a millionaire at 28 with boring, repeatable steps that you can use too. This video is a step-by-step guide to buying your first rental property. Not a hype video, not a manifest your dream life thing. It's a real plan. And by the end of it, you'll know exactly what to do, what to avoid, and how exactly to run the numbers so you don't buy a property that looks pretty but drains your bank account every single month. So let's get into it. Okay, let's start at the beginning. This is step 0, and this is the step that nobody wants to talk about. You need a down payment. So we're making this video in 2026, and most lenders will want to see at least 20% down if it's an investment property. That means every $100,000 you buy, you're putting $20,000 of your own money in. So if you're thinking, I want to buy a $200,000 rental, you're looking at $40,000 down. And that's before closing costs, inspections, and reserves. Now, if you're buying a primary residence, yes, you can put less down, 3%, 5%, sometimes even more creative options if you qualify. But for an investment property, lenders are tougher. They want more down. They want to see that you can handle it. They want more skin in the game. And listen, if you're watching this and you only have $3,000 saved, I'm not telling you to quit. It's just not going to be something that you can run out and go do today because the path is simple, but it's not fast. Save the money, learn the process, and get your credit right. Get your paperwork right. And when the time comes, you move fast. Because in real estate, the people who win are the people who are prepared. Step 1 is credit. If you need a loan, your credit score matters. It affects your interest rate. Your interest rate affects your monthly payment, and your monthly payment affects your cash flow. And cash flow is the game. Ideally, you want to score above 700. Better than that, above 740. And even better, above 760. Once you're above 740, lenders see you as low risk, and that's where you get the best pricing. If your score is 550 and you have late payments, collections, maxed out cards, don't start shopping for rentals. Start fixing that first. You want a few lines of credit that are active, paid on time, and kept low on utilization. That means if you have a credit card with $10,000 limit, you don't want to be sitting at $9,000. Keep that balance low, even if you pay it off every month. And please hear me on this. Don't pay somebody to fix your credit unless you truly have no choice. There are free ways to clean things up. There are tons of videos out there. There are easy steps that you can follow. It's work, but it's not complicated. Step 2 is your income and your tax returns. When lenders qualify you, they don't care what you feel like you make. They care what you can prove, and they care what's on paper. So most lenders will look at your last 2 years of tax returns. If you're self-employed, they average it. If you're a W-2 employee, they still want the paperwork, but it's usually more straightforward. And here's the part that matters if you're self-employed. If you write off everything, you might save on taxes, but you just hurt your borrowing power. Let's say you tell your friends you make $100,000 a year, but after write-offs, your tax returns show that you made $40,000. The lender is going to treat you like a $40,000 income person. So if you're planning to buy rental property, you need to think ahead. There are years where I keep my deductions more conservative because I want to qualify for a loan. Yes, I might pay more in taxes, but qualifying for the right loan at the right time is worth it. And lenders also want to see bank statements, usually 2 to 6 months. They'll ask for proof of reserves, proof of assets, proof of debts. They want the full picture. So start treating your finances like you're preparing for a loan, even if you're not buying for 6 months. Step 3 is to talk to a lender before you do anything else. This is the biggest mistake people make. They start browsing listings, they fall in love, and then they find out they can't afford it. Don't do that. Go to a lender first. You ask a simple question. What do I qualify for? And what will my payment be at a different purchase price? And you want a lender who can explain things clearly, not someone who talks in circles. And you don't need them to run your credit right away. You can tell them your score. You can show them your income. You can ask for estimates. The goal is to get a clean buying range. So when you look at properties, you're looking at things you can actually buy. Because here's what happens in real life. The moment you find a good deal, other people see it too. You do not have time to get your paperwork together after the fact. You want to be ready. Step 4 is to learn the market before you buy anything. Most people want to skip this and go straight to buying. And that is how you overpay. You want to look at everything in your price range. And I mean everything. 20 homes, 30 homes, 50 homes, because the way you spot a deal is by having a mental library of comparisons. You start understanding why one home is priced higher than the other. You start seeing what renovations matter and what renovations don't. You start seeing what streets are better, which ones have noise, which ones back up to something weird. And once you see enough, when the right one shows up, You feel it. You know it. You're not guessing. Step 5 is choosing the type of property you're going to be buying. This matters because not all real estate is the same. For your first rental, I like simple. Single-family homes can be great. So can duplexes, triplexes, fourplexes. And here's why the 2 to 4 unit is so powerful. It qualifies for residential financing. You can often get a 30-year fixed loan and you have multiple income streams under one roof. Once you go 5 units and up, you're in a totally different game. That's commercial financing. Different rules, different terms, and different underwriting. So for the first one, I like staying in the 2 to 4 unit range if you can. If not, a solid single family rental is a strong area to work to. I usually avoid condos for rentals, especially for beginners. Not always, but usually HOA fees can crush cash flow. And HOAs have changing rules, add assessments, and make your life a lot harder. Step 6 is to pick the right price range. I'm going to say something that might surprise you. I do not love the cheapest properties, and I also do not love the most expensive. I like the middle. I like properties that are affordable for the biggest renter pool, the biggest tenant pool, the most stable demand. And when you buy in the middle, you also tend to have better resale options also because you're not limited to one tiny group of buyers. Step 7 is the numbers. This is where most people mess up. You need to know if it cash flows. And I'm going to be honest, most properties don't. Most listings on the market, if you buy them at asking price, will not cash flow. They look good on the internet, but they do not look good on a spreadsheet. And the reason is simple. Sellers price based on what buyers will pay, not based on what makes you money. So here's how you run the numbers like an investor. First, you need your purchase price, then your down payment, then your interest rate, and then your loan terms. Ideally, 30-year fixed. Plug that into a mortgage calculator. Then you're going to add property taxes, insurance, then you're going to add repairs and maintenance, and then add vacancy. Vacancy, I usually calculate about 10%. It should be lower, but I think it's always better to be safe than sorry. And then you're going to add property management, even if you plan to self-manage, because you should still count that. And then you're going to add in an HOA if there is one. And don't pretend repairs won't happen. They definitely will. A good simple starting rule is to set aside a percentage every month for maintenance and repairs because the roof doesn't send you a calendar invite before it fails. Now, once you have your total monthly cost, compare it to the rent. Rent needs to be higher, period. And for beginners, I don't want almost, I want margin. If the property only works with nothing going wrong, it doesn't work. Now, let's do a quick example. Let's say that you buy a $400,000 property. You put 20% down. That's $80,000. You finance $320,000. Let's say your mortgage payment is around what it is for that price range. Then you add taxes, insurance, and everything else. Your real monthly cost might be around $2,500 to $2,700, depending on taxes and insurance. If that property rents for $3,200, you might have $500 to $700 a month in cash flow before you get fancy. And then on top of that, your tenant is paying down your loan every month. So you're building equity. This is why I like rentals. You get cash flow, loan pay down, and long-term appreciation. It's not one thing, it's multiple. But the deal has to be bought at the right price. And remember this, every property can cash flow at the right price. If it doesn't cash flow at the current price, the property isn't bad, the price is. Step 8 is how you estimate rent. Don't guess, don't assume, look at rent comps. Use Zillow, Redfin, Trulia. Look at active rentals. Look at closed rentals if you can. Look at what is actually getting rented and be conservative because rent is your income. If you overestimate rent, you lied on your own spreadsheet. And I'll say this too. If you're investing out of state, you need strong comps and you need a strong local knowledge because a $200 rent difference can change the entire deal. Step 9 is to find the upside. This is where real estate investors separate from everyone else. You want a property with good structure, but outdated cosmetics, old kitchen, old bathroom, old floors, ugly paint, overgrown landscaping. These are easy wins. What you don't want is foundation issues, major plumbing problems, major structural problems that blow up your budget. Cosmetic fixes can increase rent and value quickly. And if you do it right, you can improve the property without going overboard. And when you renovate a rental, think durability. No carpet, durable floors, durable countertops, simple finishes that look clean. Because tenants are not going to treat your home like a personal home. They just aren't. 18 rentals later, I have the experience to know. Step 10 is avoid location problems. You can change a lot in a house, but you cannot change where it sits. I avoid loud roads. I avoid backing up to commercial lots. I avoid weird traffic patterns. I avoid spots where it's hard to park, and I avoid things that hurt future resale. And yes, you can still make money in tough areas, but for your first rental, you want simple, you want stable, you want low drama. And step 11 is making offers. You have to learn to offer based on numbers, not emotion. You will lose offers. That's normal. I would rather miss a deal than buy a bad deal. If the numbers only work in a certain price, that's your price. If the seller wants more, let someone else buy it. Your goal is not to win a bidding war. Your goal is to buy an asset that pays you. Work with a strong agent who moves fast, communicates fast, and knows how to negotiate. That matters. Step 12 is inspections. Once you're under contract, this is where you protect yourself. Inspect everything you can: roof, electrical, plumbing, sewer lines, foundation. Every house has issues. The question is how big and how expensive. Use those inspections as a second negotiation. Ask for credits, ask for repairs, ask for a price reduction. They might say no, fine, but you ask. Step 13 is closing costs and reserves. Closing costs are real. There's lender fees, title fees, and more. A simple estimate is about 1% of the purchase price, sometimes more depending on the deal. And reserves matter. I like having extra cash after closing because stuff happens. Vacancy happens, repairs happen. You never want to buy a rental and end up broke. Step 14 is renovation and timing. If you're renovating, start quickly after closing. Every week this property sits empty is money that you're losing. You need to stay involved. Contractors are great, but they're managing many jobs. If you disappear, your job becomes less important. Check in, walk the property, ask questions. Make sure that you're not getting surprised at the end. Also, always budget more time and more money than you think. Every renovation takes longer and costs more than you think it will. Plan for it instead of being shocked. Step 15 is renting the property. Now, this part is huge. Get great photos. Hire a photographer if you can. Good photos get better tenants and higher rent. Respond fast. Renters move quickly. If you take 2 days to reply, they've already rented somewhere else. And list the property everywhere. And make sure you screen tenants properly. Income, verification, background checks, references. Do not skip screening because you have a good feeling. A rental is a business. Make sure you treat it like one. Step 16 is deciding if you self-manage or hire management. If you self-manage, you save money, but you trade time. If you hire a management, you pay a fee, but you buy back your time. For beginners, self-managing can teach you a lot, but if you hate it, don't force it forever. You can switch later. We personally have a property manager that manages all 18 of our rentals. Step 17 is the scale plan. This is what people get wrong. They think that they need 10 rentals right away, and they don't. One rental bought correctly can change your entire path. I'd rather see you buy one solid property that cash flows, learn the process, and then buy the second, because the second deal is easier than the first, and the third deal is easier than the second. You get better at spotting deals. You get better at estimating repairs. You get better at screening tenants. You get better at negotiating. So here's a simple strategy that works. Buy one property, hold it, stabilize it, save again, and then buy the next. Even if you buy a duplex every 2 years, in 10 years, you can own 5 duplexes. That's 10 units. 10 units that cash flow. 10 units that have tenants paying the loans down. 10 units that can be paid off over time. And after 20 to 30 years, you're sitting on real income.
Look what I found in my pocket. Look, fun coupon.
That's not a fantasy. It's math. It's patience. It's doing the same boring step again and again. And that's the part that people don't want to hear. Wealth is usually boring. It's not one big moment. It's a lot of small, right decisions. Now, a quick recap so that you can have a game plan. Save the down payment. Get your credit right. Get your income paperwork clean. Talk to a lender early. Study the market. Pick the right property type. Run the numbers correctly. Buy for cash flow and margin. Find cosmetic upside. Avoid bad locations. Offer based on math that makes sense. Inspect everything. Keep reserves. Make sure you screen your tenants, and then repeat. That's it. If you guys found this helpful, make sure you hit the like button, subscribe, and drop a comment. Let me know down in the comments below where you're trying to buy your first rental property. As always, guys, thanks for watching, and I'll see you on the next one.